Hey, what's up, Dividend Grow investors? Michael here for Dividend Stocks Rock. I hope you're doing well today. This is Canadian Bank's earnings review. Big shocker. National Bank went down 4% yesterday on bad results. I mean, we'll have to see about that. But today we're going to go through the big six plus EQ Bank plus GoEasy. So let's get started. All right, so year to date, when we look at banks, TD made an amazing comeback. It's kind of crazy. They were slapped by the DOJ. They got a fine. And we'll see, like the results are not that great. They're good, but they're not that great compared to other banks. And yet, investors are piling in. So year-to-date results up 42%. And of course, this has been recorded right before the market opened on the day they reported their earnings. So for TD and CIBC, I don't have the reaction from the market yet. All the others are included. You're going to see big comeback from GoEasy as well, based on the latest quarter. So that was good. That was good. For the rest of the banks, I mean, BMO, Royal Bank, CIBC, they're pretty much around the same thing. And kind of shocking, but National Bank is trailing this time. Actually, behind Scotiabank. That's kind of crazy because you know my love for Scotiabank versus for National Bank. So we'll see what exactly happened. And then we're going to also have a talk about GoEasy and EQ Bank at the end of this video. We had a question from also a listener about can they outperform the other banks, and we're going to answer this at the end. All right, so let's talk about payout ratio for a second and earnings per share. So as you can see right now on this board, no dividend increase. That's usually not the moment where we have a dividend increase. Actually, it's going to happen in Q4 for some banks, especially those that increase their dividend twice a year. In terms of earnings, it goes from +7 at TD all the way up to +22 at BMO. So we're going to take a look deeper at those results. But overall, it was pretty solid, double-digit growth everywhere. And one thing that I kind of love is now the payout ratios are back to normal. What I mean back to normal is usually you expect a 50% payout ratio roughly for banks. Now the highest one is still Scotiabank at 58, but not too long ago it was like above 60, and then even one quarter was around 70%. So being back in the 50s, that's great. Now we have three banks in the 40s with National Bank, TD, and CIBC. So while we are concerned about the Canadian economy, Canadian banks are rolling. In terms of results, here we have everything. So we're going to start with BMO. BMO had a tough patch with the personal and commercial in Canada. The name of the game here is higher revenue and more than offset by higher provision for credit losses. I added this column at the end, and you'll see they're all up double digit besides TD and Scotiabank, so we're going to get there in a moment. On the other side, for BMO, up 42% in net income on the US side. What happened there? Well, that's just PCLs again. So last year, if you remember correctly, after the acquisition of Bank of the West, they cranked up the provision for credit losses like there's no tomorrow. They were not feeling good about the US economy and their acquisition, and now they have to recover some of it. So that's why the net income is so high. If not, the revenue was like pretty much flat, like a few low single-digit movement. So nothing to write about here. It was really just a play around the provision for credit losses. Banks tend to be more conservative than anything else. That's not a bad thing, but this is what we get here. In terms of wealth and capital market, up double digit. The PCLs, again, overall was up 14%, mostly driven by PCLs in Canada. And that has been the undergoing narrative for all the other banks, actually. National Bank, I mean, when you look at the results, why would the stock drop by 4%, right? We're going to get there towards the end of the video. But overall, it was a good quarter in terms of personal commercial in Canada, up 5%. International and Credit G was up 13%. Wealth management did well. I mean, record assets under management and higher fees on all of those assets that are being managed across the board. All banks did well. The market is going well. Wealth management is going well. The business is quite simple. you gather as much assets as possible. You charge a fee on that. So when the market goes up, investors invest more. The assets under management increase, and there you go. Boom, you're making more money. Capital market only up 5%. Sometimes, usually they're up double digit there. So that was also a bit of a disappointment. And one hint about why the market didn't like the results. PCL is up 36%. Again, mostly in Canada, of course. So that was not that great. The CEO mentioned that the integration of Canadian Western Bank is going well. They're creating even more synergies already, saving more millions of dollars. So this is moving forward right away. But the PCLs is definitely a rock in their shoes. TD Bank, as I said, not amazing results, but I mean, not so bad actually. Personal and commercial banking in Canada up 4%, down 18% in the US, mostly driven by higher fees. Of course, they're capped in terms of assets, and now they have to work with regulators. So I told you that in the past that was going to hurt their short-term US performance. In wealth and insurance, that did incredibly well. So that was a good news. And then capital market up 26%. One thing that I really love about this one is the PCLs were down 9%. The only one that was really down. I mean, BNS, Scotiabank is slightly down, but not that much. So again, very good. For Royal Bank, the personal side went very well. Commercial, not so much. I mean, up 2%. It's okay, but it's not flabbergasting. The insurance business did well, as similar to what happened with TD. Wealth, capital market, double digit. The PCL is up, but really, Royal Bank reported a solid quarter across the board. And one thing that you'll notice is even though PCLs are increasing for most banks, their revenue and their net income is increasing faster. So it's not a slowdown for their progression so far. CIBC continues to impress. I mean, we're talking up 17% for personal and commercial, for US, up 19% for wealth. Capital market exploded this one. Again, keep in mind, that's really volatile, but still very, very solid. And among the smallest increase of PCLs as well. And finally, Scotiabank, again, similar story here, a little bit more difficulty in Canada. However, in the international business, it's going very well. So lower PCLs, higher revenue, up 7%, kind of like that. And then the PCLs were flat for this one. So that was a pretty solid quarter for Scotiabank. The market liked it as well. Now, which bank should you be buying at this point? I'm not too sure, because if you look at the forward P ratio on this chart, you will notice that all banks are trading above a forward P ratio of 12, which is actually a rich valuation. Many, many times you're going to find banks around 10 and 11 times their earnings. So at 12, it's already pushing the envelope a little bit. Royal Bank and Bank of Montreal at like 14 and almost 14 and 14 and a half. That's getting a little bit more expensive. Again, when you see National Bank is in the middle of the group right now at 13, it used to be among the highest one. The recent drop is explaining as well why the National Bank forward PE ratio is a bit lower than others. But I'm going to get there. I'm going to end up with these questions. We're going to take a quick break from the big six, and we're going to move towards EQ Bank and GoEasy. So for EQ Bank, if you remember, year-to-date return like 3% up, not much, but actually what you look here is a weak quarter. So revenue were flat. Earnings per share were down 18%. So what's happening right now is they have strong loan origination. So they're making a lot of loans, but earnings are getting hurt by higher PCLs. They have like impaired commercial loans in the quarter. So it was not the best one ever. And one thing that I've started to follow a little bit more is the ratio of PCLs. So the provision for credit losses on their loan book. In 2024, in Q2, it was 23 basis points of their portfolio. It went up to 28 this year in Q1, and then 29 in the second quarter. So a bit, I mean, it's not crazy here, but you can see that it's increasing. You can see that it's hurting earnings, and that kind of explained why EQ Bank has not been doing that well this year so far, lagging behind the TSX 60. For GoEasy, strong loan origination as well. In my opinion, it was a mixed quarter in a sense where revenue was up 11%, but earnings were flat, mostly because of weaker margins. So they're making a little bit less money on the loans, and that's why the earnings were flat. So it was an okay quarter. I'm a bit surprised that the stock price went up that far, but sometimes it happens as well. So what we learned this quarter? Well, PCLs increase almost across the board for Canadian banks. So that is not concerning, but it's a good sign that the Canadian economy is not doing that well. Mostly because PCLs increase for Canadian activities, a little bit less for US or international. So once again, that gives us the signal that, yeah, maybe we're going to have a rough winter. Nothing to worry about for banks, but maybe for the global economy. CIBC and Scotiabank are making a good comeback. So that's really interesting. TD investors are buying the narrative with a new CEO, with the asset recycling, and they just want to get back on track. So that was interesting. There were also a lot of mentions about introducing AI to boost productivity and improve client service across banks. So that's going to be interesting to see. And finally, what happened with National Bank stock price? Okay, so first, a stock price that dropped by 4%, not the end of the world, especially because it went to its all-time high at $150 just before. So the expectations were really high from the market, from financial analysts, and that is one thing that will hurt when you have results, even though they're good. If you disappoint financial analysts, you will see your stock price drop. Like, it's all priced for the future, and then when you're telling analysts, yeah, well, the future is good, but not as good as you thought, well, there you go. You already have a drop. That is one thing. The second thing is when you look at the PCLs, I mean, up 36% from last year, that's a lot. And when you look at the first 9 months of the year, because we're in Q3 for fiscal year for Canadian banks, it's going up big time. And this is something that I've mentioned in the previous quarters that I didn't like that. And now I see that it's kind of like a trend that is building up. Of course, it can change rapidly. I mentioned that in 24 about BMO, and then BMO came back. The year before, it was CIBC story with a big provision for credit losses, and in 24 it was recovered, and this is explaining a big part of their coming back on the stock market as well. So for National Bank, those were the two biggest elements, in my opinion, was really the higher PCLs and the fact that this disappointed the analysts. If you want to know how to analyze quarterly earnings and understand why price goes up or down after news, I will have a webinar explaining you this. So I'm going to read quarterly earnings with you. We're going to have a framework that is going to enable you to read those rapidly, identify the key points, and finally analyze the stock with a dividend analysis. You can register for free at moosemarkets.com/webinar. The link will be in the show note as well. And of course, after the webinar, we're going to have a full hour of Q&A, so you can ask me all kind of questions. Speaking of Q&As, I do have a question from Jogging Boy on YouTube, who was asking me, Mike, do you think that online banks or lenders like EQ Bank and GoEasy are likely to be more profitable than traditional banks over short, medium, or longer terms? Very interesting, because we know the hype of those smaller lenders. They're more agile. EQ Bank goes online. It does a lot of things online. GoEasy as well. So there is a hype among consumers. And then you may be thinking, well, if they're grabbing so much deposits and accounts and they're doing loans, probably they're going to take off. And EQ Bank has been a very strong performer for the past few years. Same thing with GoEasy. But moving forward, the problem I see here, it's really hard to compare both business model, because those two small lenders are focused on classic banking activities, so deposits and loans and mortgages, while big banks are now well diversified. And one thing that is great, and while you have higher PCLs, for example, right now, because we're not too sure about the economy, well, big banks can rely on wealth management, capital market, insurance, growing outside Canada. All of those tools will help them improve their results. And this is what we have been seeing so far this year, as opposed to an EQ bank that is kind of stuck doing the same business. And this has brought them to having a tougher year this year, not catastrophic, but it's hard to grow. So for that reason, I would still put my $2 on banks and not on smaller lenders, not because I don't like them and I think it could be a great addition to the portfolio, but over time, I will always prefer quality and diversification over a smaller player. But that's just me. That's not you. Thus, that was not financial advice or buy or sell recommendation, but I hope that you have enjoyed this answer to your question, Jogging Boy. I know you've been following me for a while, so thank you for that. So, all right, guys, that's enough for today. Do not forget to subscribe to the channel. I'm back with videos every single week. So next week, we're going to talk about the new additions that I made to my portfolio, 1K per month throughout summertime because I took a break. So you don't want to miss this. So subscribe to the channel, give me a like, give me a thumbs up, and we're going to talk again next week. Until then, don't forget to stay invested.